Welcome back to the Rundown Lab, where we break down and fact check the biggest health podcasts. We know your time is valuable, but when you can, we always recommend catching the full episode. Links are in the description. The Diary of a CEO's Early Retirement episode. Here's some good news for anyone interested in building wealth. A recent viral episode on personal finance actually gets most of its facts right. But there's one major claim that's wildly off the mark, and it could seriously distort how you think about your investment options. In this episode of The Diary of a CEO, titled Early Retirement Expert, A House versus Stocks, here's the truth. The guest dives deep into personal finance statistics, comparing homeownership to stock investing, examining why some people become millionaires while others struggle, and breaking down the financial challenges facing American households. After reviewing over 40 individual claims, I found this to be genuinely solid financial education content. About 3/4 of the claims check out as accurate or mostly accurate. The speaker clearly knows their statistics. But let's break down what they nailed, where things got murky, and the one claim you should absolutely ignore. Let's start with the good stuff, because there's a lot of it. The episode opens with a striking statistic. Homeowners in America are worth 40 times more than renters on average. This checks out. The Federal Reserve's Survey of Consumer Finances shows homeowner median net worth around $396,000, compared to just over $10,000 for renters. That's roughly a 38-to-1 ratio. The investment math presented is solid, too. The claim that investing about $27 per day for 40 years at historical market returns would yield over $4 million? That's legitimate. At 10% annual returns, which aligns with long-term stock market averages, that daily contribution adds up to around $4.8 million. The caveat, of course, is that this assumes consistent returns, without accounting for fees, taxes, or the reality that markets don't move in straight lines. Speaking of market returns, the episode correctly states that the U.S. stock market has averaged over 10% annually for more than a century, with dividends reinvested. This aligns with data from sources like NYU Stern going back to 1926. The Vanguard fund examples given, VTI returning around 14% over the past decade, and the Vanguard Balance Fund averaging over 8% since inception, these also check out. The statistics on 401k millionaires are accurate and actually pretty inspiring. Fidelity did report over 600,000 participants with account balances exceeding $1 million. And yes, these savers typically contributed around 14% of their gross income, maintained roughly 70% stock allocations, and stayed invested for 25+ years. The lesson here about consistency really is supported by the data. Other accurate claims include the 90,000 hours most people work over their careers, women's longer life expectancy creating greater retirement planning needs, women achieving slightly better investment returns than men, according to Fidelity and academic research, and the sobering reality that the majority of day traders lose money. Some studies suggest up to 97% who persist lose over time. The Social Security projections are unfortunately accurate too. The 2033 funding shortfall and potential 20% benefit cuts come straight from the Social Security Trustees report. And yes, the average benefit currently sits around $1,900 monthly. Now, let's address some claims that are technically in the ballpark, but need important context. The episode states that 70% of Americans live paycheck to paycheck. Various surveys do report figures between 55 and 78%, so 70 isn't unreasonable. But here's the nuance. These surveys define paycheck to paycheck differently. Some include people who could cover expenses, but simply choose not to save much. It's a real issue, but the headline number can be misleading about how many people are truly in financial distress. There's also some inconsistency within the episode itself. At one point, the speaker claims 50% of Americans can't access $1,000 for emergencies. Later, they say 40%. The actual figure from bank rate surveys fluctuates in the 40 to 57% range depending on the year and methodology. Both claims are in the ballpark, but the inconsistency suggests these statistics are being cited from memory rather than carefully verified. The claim that women work 7 to 11 fewer years than men due to having children oversimplifies the research. Studies suggest the gap for mothers is closer to 4 to 7 years, and it varies enormously based on education, income, and whether we're including elder care responsibilities. Not all women have children, and framing this as a universal experience misses important nuance. On emergency savings, saying more than half of Americans have no savings conflates two different problems. Many Americans do have some savings, just inadequate amounts. There's a meaningful difference between having literally $0 saved and having less than $1,000. The more accurate statement would be that more than half have insufficient emergency savings. The claim that financial disagreements are the leading cause of divorce is often repeated, but research is actually mixed on this. Money problems consistently rank in the top 2 or 3 causes, but some studies place infidelity or communication issues higher. Financial stress also tends to intertwine with other relationship problems, making causation hard to untangle. The major red flag. Now for the claim that's just plain wrong. The episode states that housing prices have increased 400% over the past 20 years. This is false, and it's not even close. The Case-Shiller National Home Price Index shows national home prices roughly doubled from 2004 to 2024. That's a 100% gain, not 400%. Even in the hottest markets, think San Francisco or Miami, 400% appreciation over 20 years is extremely rare. This matters enormously because the episode is explicitly comparing housing to stock market returns. Getting housing returns wrong by a factor of 4 completely distorts that comparison. For accuracy, stocks returned roughly 600% over 20 years with dividends reinvested, while housing nationally returned about 100%. The episode actually cited 1% annual real appreciation for housing elsewhere, which is accurate according to Robert Shiller's century-long research. But the 400% claim directly contradicts this and could lead viewers to dramatically overestimate housing as an investment. There's also a claim that the average American with a 401k saves only 3 to 5% of income. Vanguard's How America Saves report shows the actual average is around 7.4%, with median around 6%. Including employer matches, total savings rates average 11 to 12%. The 3 to 5% figure significantly understates what people are actually doing, which creates an unnecessarily pessimistic picture. The bottom line. Overall, this episode deserves a solid B+ for accuracy. The speaker demonstrates genuine knowledge of personal finance data, and most claims align with reputable sources like the Federal Reserve, Fidelity, Vanguard, and government agencies. The investing advice, save consistently, stay invested in diversified funds, understand compound growth, is fundamentally sound. However, there's a pattern of slightly pessimistic framing that's common in motivational financial content. It's easier to capture attention by emphasizing how badly everyone else is doing. More importantly, that 400% housing appreciation claim is a significant error that could genuinely mislead people making major financial decisions. The takeaway? This is worthwhile financial education content, but as with any podcast, verify the specific statistics before making decisions based on them, especially when someone's comparing your 2 biggest potential investments. The truth about houses versus stocks is nuanced, and getting the numbers right actually matters.